So I figured out that if so what I did is I bought in 2013, $200 per Bitcoin. It went up to,
whoa.
It went up to 1,000 in 6 weeks. But I had a long-term thesis. I wrote the first kind of macro strategy paper about the valuation of Bitcoin. I thought this could be worth $1 million. And let's assume I'm an idiot by 90%, it's still worth 100 grand. So this is the best bet I've ever seen. So I held on, and then it fell 82%. And I'm like, wow. But I'd taken the bet, and I put money in, was not levered, and I could afford to take the bet. So I just thought, I'm just going to forget about this and just see, because this is a longer term thing, and you don't normally make money that fast and doesn't normally fall this fast. So let's just see. And then I kind of forgot about it, 2014, and then 2015 starts going up again. And then by 2017, I'm now mentally scarred from an 82% drop, coulda, woulda, shoulda. I then see confusion in the market about either we're going to fork Bitcoin to two different chains. The price is 2,000. I'm now up tenfold. I'm a genius. My macro bet has paid off, sort of. I sell out. It goes up to 20,000 in 3 months later, and I don't mind. I don't mind because I've made 10 times my money. What I did was deviate from my thesis. My thesis was this was a 10-year bet, and I took the money off the table within 5. And then I went back, and then obviously I bought back in May, something like that, 2020, and had a good run and put more money into it than I had originally in my original bet. Okay, so my view, and it still remains, even though it seems pretty unfashionable right now with inflation at 8.5%, my view remains exactly what you talked about, is as prices go up, the economy slows down with the exact mechanism, and therefore it becomes self-regulating. And it becomes that because people are quite in debt, and it's a very old population in the US and Europe and elsewhere. So if you raise prices on your retired parents, they can't earn more money because they've got their pension, and that's it. So what happens is they end up buying less, and there's a big cohort of people. So that's why I think it automatically over time. But the other mechanism is the bond market, which is a fancy name for saying interest rates. The price that you and I and companies and governments can borrow. So if it becomes more expensive to borrow, so think of your mortgage, if you've got a mortgage, well then if it becomes more expensive to borrow, then you spend less. So leverage works in crypto that you have some Bitcoin and you want to borrow some US dollars or whatever it is you want to do. So you will pledge, and your interest payments
as collateral,
and your interest payments are whatever they are. But what happens is if the collateral falls and the exchange or whoever it is, or the DeFi protocol says, oh, it doesn't cover the amount, you get liquidated immediately. There's no negotiation, no, oh please, no nothing, just like boom, out. And you take the loss. Go into the financial markets, like the futures markets, which is mainly for accredited or sophisticated investors. It's not an instant liquidation, and that's terrifying because suddenly something like the oil price. Let's say you've bought some oil futures. What that is leverage on the future price of oil, much like you would do with Bitcoin. Oil sometimes can go down 10% a day, and because you've got leverage, before you know it, you're losing enormous sums of money. They don't liquidate you. They call you up and tell you you owe them margin, and you can get yourself in a huge mess. So leverage is very scary. The nice way of playing leverage is options. Options is something definitely worth people learning about. You're okay still. So it's just a different way of doing risk. I think there is a narrative that says that the Fed have to do this, but you and I don't borrow at Fed funds rates. The market's already changed our mortgage costs or whatever. So I think the market does its job, but there's some belief that it has to be driven by the Fed and their Fed funds rate. So that is, I think, more of a red herring. I think the free market does its job. However, they have one more other thing in their arsenal, and that is the balance sheet. Printing money or taking money out of the economy. And when they print money, they're buying the bonds of the government. So the Federal Reserve are buying the bonds of the government. So it allows the government to borrow more without causing any problems. So right now they're about to start tightening, quantitative tightening. People hear the terminology. And what that basically is a fancy word for, we're going to take some money out of the economy. And
they're going to take money out, or they're just not going to put as much in?
Well, if they stop quantitative easing, which is the first step, which they've done, that's not putting any money in, extra money in. When they do quantitative tightening, they take money out. So if there's a big pool of money sitting there, and they say, listen, we're going to take 5% of that out every year, that less money around, so the Fed can engineer it by trying to raise interest rates, and it filters through to our mortgages and other stuff. Or the market kind of clears of its own accord, where prices get too much, people stop buying stuff, prices fall back again. So either way tends to work, and we're in this weird mess where the Federal Reserve are doing it, the markets are doing it, and we're having to take all the pain in the meantime. I generally think that the market is better at doing it. If you actually see it, from my perspective, somebody closely follows interest rate markets and stuff like that, they did all of the tightening anyway, well before the Fed. You hear the expression, the Fed are behind the curve. What it means is the bond market's already priced it. Interest rates need to go up to slow down the economy because there's too much inflation, and the Federal Reserve are trying to catch up. I actually think the markets do a pretty decent job in the way that you suggest. Prices rise, eventually it gets too expensive, we stop doing it. Now, there's different equations that people fear is when it becomes super entrenched in the economy, and we all go to our bosses and go, I want a pay rise, and everybody does that at the same time. That pushes up prices further, you get more wage rises, and let's talk about it in financial market terms or macro terms. I think there's three things you need to do here. One, income. Income rules the world. Income pays your bills. Income can pay your mortgage. Income does everything. Secondly, is you need to have optionality. You need to have things that can pay off. A startup or a hobby business on the side can give you optionality, because you can build a business, and a business has intrinsic value, plus it can increase your income. That will never happen if you work for a corporation. Yes, you can have a great career and do fine, but you'll never have that extra upside that you and I have had by building businesses. So that is another thing, is focus on your income, work hard, look for other opportunities that can leverage that income and opportunity set that you've got for you. And then thirdly is, if I've got this income, look for investment opportunities that can change my life. And that doesn't mean being a degenerate gambler. It's like, simply put, if there is a thesis, for example, in cryptocurrency that you and I share, that this is a long-term network adoption of this incredible technology that is exponential in nature and highly volatile, you should be looking at the moments of extreme weakness, the blood on the streets moment, to be buying more, not on leverage, but just putting your money into it. So if you'd have bought a house after the 2008 crisis, you'd have done very well. If you'd have bought it at the peak, you'll have done less well, right? So timing matters. And I looked at this to give you a specific example, just wrote a whole article about this, is I went back with a bit of honesty, thinking, I'm looking at my ETH price and I'm going, why didn't I sell it at 3,000? I should have just, I could have bought it back cheaper. And I know that that is a siren song that goes in your head, right? Mental torture. And I've been in this space since 2013. So I went back and looked at my entries and exits and what I did in the past. And what had happened if I just bought and hold? And what had happened if I bought and hold and added when it was this far oversold?